Good afternoon, esteemed members, students, and all participants. On behalf of the Direct Access Committee ICAI, I welcome you all for today's webinar. I am CA Sumana Emra, your moderator for today's webinar titled Tax Audit Compliance Requirements, a Panoramic View, organized by the Direct Access Committee of ICAI. As you may know, Section 44AB of Income Tax Act governing the tax audit provisions has been instrumental for over 4 decades in ensuring the accurate maintenance of books of account and related records, thus reflecting the true income of taxpayers and aiding in the proper administration of tax laws. To delve deeper into the nuances of tax audits, we are privileged to have our speaker, CA Krishna Upadhyaya, who will be leading this session. CA Krishna Upadhyaya is a distinguished commerce graduate and a fellow member of ICAI, who secured an All India 27th rank in CA final exam in 2011. He has cleared all levels of CA exam on his first attempt. Presently, he serves as a member of Direct Tax Committee at the Bombay Chartered Accountants Society and is a charter member of TIE Mangaluru. He has delivered numerous lectures at ICAI, ICSI, KSCAA, and BCAA study circles and seminars. Additionally, CA Krishna Upadhyaya has served on various panels discussing a wide range of topics, including income tax, international tax valuation, FEMA, and startup funding, to name a few. He has also contributed articles, journals, and co-authored several books of professional interest. C. Krishna Upadhyaya began his career as a consultant with Ernst & Young, and after a short stint at EY, he has played a vital role in assisting his clients in his own firm, Upadhyaya and Associates in Bangalore, for over a decade with direct tax litigation, India entry strategy, cross-border tax structuring, corporate taxation, and transfer pricing, mergers, acquisitions, and HIVOPs. Beyond his expertise in tax, CA Krishna Upadhyaya is deeply interested in tech-enabled finance practices and is the co-founder of a startup named Advit iTech. We are delighted to welcome him for today's session. With this brief introduction of today's distinguished speaker, I now hand over the session to CA Krishna Upadhyaya. Over to you, sir.
Thank you so much, madam, for the introduction. Good afternoon, everyone. It's a privilege and it's an honor that the Direct Tax Committee of the ICAI found me worthy to be talking about this subject, which is the tax audit, which is a very pertinent subject at this point in time in the year. Most of the professionals who are in practice, students who are a part of the firm doing their articleship, as well as auditees, will be keenly looking at how to sort of navigate this entire journey of tax audit. Over maybe the next an hour or so, I will try and delve into as many detailing as possible about the tax audit and how to go about addressing various questions that are there in the Form 3CD, which is a key part of the reporting. Maybe also in the end, as time permits and as permitted by the moderator, I'll also take a few questions that you all may have. Kindly post those questions in your Q&A box, which can be answered by me. I will share my screen, keep my video off for a while for better bandwidth and connectivity, and I'll just come on video again, probably at the end of this session. So kindly let me know if you all can see my screen.
Yes, it's visible.
Thank you. So firstly, some basics about tax audit and the audit itself. As most of you know, Section 44AB provides for the applicability of tax audit. So one interesting feature, which is at the time when the section was being introduced into the law, the memorandum explaining the introduction of this piece of the provision actually detailed out what is the reason and the intent behind introducing this provision. That clearly lays down the foundation of how, as an auditor, as a tax auditor, we all are supposed to perform our duties. The memorandum explaining the introduction of the law states that the entire concept of the tax audit became a necessity because of the reason that the entire computation of tax, the mechanism of computing the tax started becoming more complex. The Ministry of Finance and the Board of Direct Taxes felt it necessary to ensure that there is a help given to the assessing officers by a professional who could help them compute the taxes. In order to make sure that there was a help given to them in arriving at the right taxes for a particular threshold and above, tax audit was introduced into the law books. Who is it applicable today? Again, this is something that is very clear and known to most of you, but I'll still try and explain it. Firstly, if for a business entity, sales turnover gross receipts exceeding 1 crore is where the tax audit becomes applicable. This limit is substituted by a limit of 10 crore if the sales turnover gross received in cash does not exceed 5% of the total receipts, and aggregate payments of the expenditure in cash does not exceed 5% of the total payments. So in case these two are cumulatively satisfied, that is the cash receipts out of the total are less than 5% and cash payments out of the total payments are less than 5%, then the limit for applicability of tax audit for a business entity is increased from 1 crore to 10 crores. Second, I think the other limit is on the gross receipts in profession. The gross receipts in profession exceeding a certain limit, again, you don't have the tax audit applicable. Tax audit is applicable in case where the gross receipts are in excess of 50 lakhs. Subsequently, person carrying on business taxable under 44 AE, BB or triple B, all of these are presumptive taxation of various kinds. If they claim that the deemed income, which is given in the respective provision, is less than the income as provided in those sections, then again the tax audit becomes applicable. In case they are declaring the income as per the deeming provision which is there in the respective sections, then you don't need to get yourself into tax audit. What also happens is that in case a person carrying on profession taxable under 44 ADA, which is again a deeming provision, claims that the income is lower than the deemed income of 50%, which is there in that, they'll have to get their books of accounts audited. In case 44 AD is another deeming provision, which talks about a deeming percentage that can be offered to tax for business entities, certain specified businesses. In case a particular situation comes up where 44 ADA 4 is applicable, then tax audit becomes applicable. I have detailed this out in the subsequent slide. I'll talk about it at that point in time. One new proviso that got introduced, which is from 1/4/2024, which is assessment year 24-25. 44 AD is again not applicable when person declares profit under 44 AD1 or 44 ADA1. This was more like a clarificatory proviso that got introduced, whereby if already 44 AD1 or 44 ADA1 is applicable and the declaration of profit is happening as per that, 44 AD is not applicable. Important thing, just going into the 3CD itself. 3CD in the first part, in the part A, talks about the relevant clause under 44 AB under which the audit is being conducted. Serial number 8 of part A talks about it. You will have to be careful in choosing the right kind of subclause over there to make sure that the audit is being carried out in the right clause. One important thing again is that wherever audit is applicable for an LLP, company, cooperative society or trust, which are audited by the respective law and for whom tax audit is being carried out, third proviso is to be chosen. This is sometimes I have seen people not correctly choosing it. That is why I felt it is important for me to highlight this at this point in time. Now, what does business mean? So we spoke about turnovers based on business, turnover based on profession. So what does business mean? Business is said to include trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture. It does not necessarily mean manufacture only, is a clarification that was given out by Supreme Court in a very old judgment in 1981. where they said that it can mean any trade, commerce, and not necessarily manufacture alone. So this is important. There are a few particular scenarios how this is to be interpreted, which also I have detailed out in the subsequent slides. Section 2 bracket 13 defines the word business, which includes trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture. The definition of profession as given in section 2 says profession includes vocation. This is a very short definition which is there, which is more left for all of us to interpret. Over the years, there is clarity on this, though section 2 bracket 36 is a small definition which only says profession includes vocation. There have been judgments, there have been jurisprudence on this, which clearly tells what profession really means. Apart from this, there are also list of professions which are given out in section 44A, read with rule 6F. I have listed down here. So one needs to be careful that only in case it covers under one of these, they will be called professional for the purpose of section 44 ADA as well as section 44 AB. What are those? You can see the list here: legal, medical, engineering, architectural, profession of accountancy, technical consultancy, interior decorator. Some of them here could be slightly overlapping in confusion. It could rather lead into a confusion. One needs to make sure that they can look into following two things. One, the institute's guidance note on 44AB is pretty elaborate. A lot of scenarios in case of confusions have already been answered in the guidance note. I would highly recommend one to have a copy of the guidance note always with them, because that is a very exhaustive book on how audit under section 44 is to be done. Some of the other notified professions under 6F and the notifications thereunder includes authorized representative, company secretary, film artists and actors, cameraman, director, and the entire film fraternity have been brought under the list of profession. Like I said, a few important milestone judgments which are there on the matters of what is a business, what is a profession, I have listed on. Why it becomes important, as you all know that the deeming provision, the limits for the deeming provisions are different for both of them. Therefore, it becomes essential to know what is the distinction between business and profession. Nursing homes have been held to be business in a wide variety of judgments. There are a lot of judgments which have said that nursing homes are business and they are not profession. Just to cut the entire detailing short, one of the reasons why it has been held so is because for a profession to be there, the courts have generally held that it should be an individual skill which is getting displayed and a skill which is acquired by way of a specialized course, and that knowledge is depicted, only then it becomes a profession. Nursing home, on the contrary, they have said that is more akin to a business entity and therefore not profession. The words sales, turnover, gross receipts are very commercial terms. There are no definitions of all of this under the income tax law, and they should be construed in accordance with the methods of accounting generally employed by the SSC. And this have been accepted to be a norm by the courts as well as the income tax authorities. A few important maybe definitions or coverage or non-coverages in the word sales, turnover, or gross receipt. First, sale proceeds of fixed asset would not form part of the turnover, since these are not held for sale. Because of the reason that they are not held for sale, they don't form part of the gross receipt. Let's take a scenario where an SSC has an exempt income. And their incomes are exempt under, let's say, claiming of a deduction under Chapter 6A or anything like that. For the purpose of the turnover or gross receipt itself, you should not apply those deductions or exemptions. You need to consider them before that. So the gross receipt signifies that these are before considering exemptions and deductions. And therefore, if it exceeds the threshold which is given in 44AB, In such cases, tax audit becomes applicable. One example that I've given here is cooperative society claiming ATP deduction. Even when the deduction is there for the entire profits that such a cooperative society enjoys, provided it satisfies conditions given under ATP, irrespective of that, tax audit will still become applicable. Agriculturist, somebody may have a substantial agricultural income. In case they don't have any other income under PGBP, that is profits and gains from business or profession, agricultural income alone doesn't constitute turnover, gross receipts, or sales for the purpose of Section 44AB, even though it exceeds the threshold which is given there. Next is the situation of a commission agent. This can be slightly tricky and peculiar. There could be different kinds of commissionerate agreements which are there. There could be a commissioner simplicitor agreements. There could be a buy-sell agreement that the commission agent enters into. It will be necessary to find out what is the nature of that agreement, whether the property in that goods are getting transferred in favor of the commission agent, or all the risk, reward, and ownership is getting transferred or not. In case it is getting transferred, then the value of the goods should also be included while computing the term or the threshold for the purpose of determining applicability of tax audit. In case it is not getting transferred, he is only acting as an agent, he is only acting as a consignee. In such situations, only the commission that he earns by carrying out that activity will be counted for the purpose of sales turnover or gross receipts. Creditable indirect taxes, whenever they are accounted separately. So as you might be aware, there are two methods of accounting that is generally followed. The guidance note on 44AB goes into good depth of talking about it. In case there are creditable indirect taxes, let's say like GST, what you're collecting and what you're discharging on purchases. Let's say you route all of this through the P&L account. That is called as an inclusive method of accounting. In case they are one is following an inclusive method of accounting consistently, in such situations, the turnover or gross receipts should include those indirect taxes. In case they are accounted separately and an exclusive method of accounting is followed, it should not be counted for the purpose of turnover. Again, one may have a doubt about what to do with sale of scrap, because in a lot of situations we may account it as other income, because that could not be the main operating activity of a certain business, but there could be a scrap that gets generated as a part of an ordinary course of one's manufacturing operations. In such a situation, it is recommended that sale of scrap also be included as a part of quantum of turnover to compute the thresholds for tax audit. These are the kind of transactions which are becoming popular of late. Speculative transactions, which are non-speculative in the nature of futures and options. These are becoming very popular. There are a lot of people who are getting into such transactions, even those who are not actively in business, but people could be salaried individuals, people could be earning rental incomes. They are getting into speculative transactions of shares in particular. In such situations, how turnover has to be determined, the difference between the price agreed to be purchased at and sold at, that difference is to be considered as turnover. Aggregate of positive and negative differences should be considered for the purpose of doing this. Again, the guidance note gives you with illustration how this has to be done. In the case of derivatives, futures and options, like I mentioned, the popularity of these kind of transactions are growing. One needs to be very careful. You'll have to take the accumulation of favorable and unfavorable transactions without considering the plus or minus of it, accumulate it, and that will determine whether it is matching the threshold or crossing the threshold for the applicability of tax audit. Share of profit from a firm is not to be included for the purpose of computing gross receipts. There could be an SSE who has, let's say, a business income from a proprietary business. Let's take, for example, his gross receipts from such proprietary business is 75 lakhs. he has a share of profit from firms in which he is a partner, totaling to, let's say, 30 lakhs. In that situation, the limit, if you cumulate it, exceeds 1 crore 5, it becomes 1 crore 5 lakhs. But it is to be noted that share of profit, though is an exempt income, number one. Number two, also part of the profits and gains for business or profession, but should not be included for the purpose of computing the threshold for tax audit. This is an interesting matter. This had a little bit of debate and it reached courts at multiple situations. There were contrary judgments, one judgment of the Kolkata tribunal, which was there, and there was a Chennai tribunal decision, which was there, which is whether interest or remuneration received from a firm, should it be considered as a part of the limit for tax audit or not. Tax authorities were arguing that yes, it should be considered. And the Kolkata tribunal also, if I recollect correctly, had concurred with it, but the Chennai tribunal had said you should not. We have a High Court judgment now, which came in 2022, the Bombay High Court judgment in Perizad Zorabian. Perizad Zorabian, some of you might know, is a film artist. She had a individual acting career, which used to give her certain receipts. Plus, she was a partner in a firm which used to handle all her advertisements and brand promotions and all of that. So the question was whether the remuneration and interest received from such partnership firm should also be included as a part of computing the turnover for tax audit. The Bombay High Court, in my view, also rightfully said that it should not be considered. Now, another question which often gets asked and which results into some confusion is, what if there are more than one business run by a person? Let's take an example where there is a person who's running a petrol pump as a proprietary entity, plus he's also running a restaurant. Now, the question that arises is whether, for the purpose of tax audit, should you combine both the turnovers and then apply the tax audit, or should you take each of them separately and determine whether tax audit is to be done or not. In this situation, the guidance note para 5.17 clearly states that in case an SSE has multiple businesses, the turnovers of all those businesses have to be consolidated for the purpose of determining applicability of tax audit. However, in case there are certain receipts which qualify under 44B, BBA, AD, ADA, and that SEC wants to go under the respective presumptive income taxation, then you will have to exclude it from the computation of turnover for the purpose of tax audit. In case they don't wish to go under it, or they are not covered by that, then you don't, rather you don't have a choice. You will have to accumulate it and then aggregate it and find out turnover for the purpose of tax audit. Now, what I have done is that, as you know, 44 AD talks about presumptive taxation in the case of eligible businesses. 44 AB talks about applicability of tax audit. There is a certain interplay between these two. There are some situations where 44 AD is applicable and 44 AB is not applicable. Some situations where 44 AD 4 becomes applicable and therefore 44 AB will become applicable. By way of a table, I have tried to capture this entire interplay. This needs to be very carefully looked at. I will try and explain to the best of my ability, and I hope I'll be able to help you understand this. Now, firstly, under 44 AD, which talks about presumptive taxation, it clearly says it is applicable for eligible SSE. And the definition of eligible SSE includes individual, HUF, but does not and partnership firms, but does not include LLPs. So there is no question, therefore, of a presumptive taxation for LLPs. And naturally, companies and other forms of entity are out of scope from the applicability. Eligible SSE are only individual, HUF or a partnership firm, and who is a resident this again, presumptive taxation is not applicable for a non-resident. Let's take the first scenario is, let's say the turnover is less than 1 crore. Now, why have I kept 1 crore here is 44AB fixes a limit of 1 crore. Why have I taken the next 1 to 3 crore? 44AD, especially for this year and onwards, assessment year 24-25 and onwards, can be applied up to 3 crores. And 10 crore is a limit which we already spoke about when we were talking 44 AB applicability in certain situations. Therefore, I have divided this entire possibilities into 4 scenarios where the turnover is less than 1 crore, is between 1 crore and 3 crores, is between 3 crore and 10 crores, and is more than 10 crores. Firstly, let's say somebody has a declared profit less than 8% or 6%. Why again I have chosen the 8 and 6% here? The presumptive taxation 44AD has these two limits. One can declare a straight away 8% in cases where their incomes include even cash receipts. If it is only bank receipts, they can declare a straight away presumptive profit of 6% under 44AD. Therefore, I have chosen these thresholds. Let's say if their turnover is less than 1 crore, declared profit is, let's say the actual profit that they have is less than 8% or 6%. Whether they can go under 44AD, it's not mandatory, it is optional. They can either choose to go under 44AD and declare a 8 or a 6% as may be applicable, or they may not do. Now you may ask, okay, if it is an option, why would they want to go under that and want to declare? As you know, once a presumptive taxation is opted for, the tax authorities will not go deep dwell into whether the payments were made in cash, not made in cash, and etc. What are the bills available? All of this are not checked. That is what is the schematic way of how 44AD works. And for that reason, one may want to go under 4480. That is an option, but not mandate. In case they don't opt for 4480, the return allows you to mention a profit and loss account. It also allows you to mention a balance sheet and declare a profit percentage as which is your actuals. That means you can maintain a very rough books of accounts and prepare a balance sheet and P&L. Don't have to get it audited and yet declare whatever is your percentage of profit. This is in the situation where it is less than 1 crore. I know some of you may think this is incorrect. Wherever I speak about this, I have always been told this is an incorrect interpretation, but I believe very strongly this is the right interpretation, and it is also supported by how the schema of the return itself is prepared. Now let's take the next scenario. Their turnover exceeds 1 crore. That means 44AB kicks in. You'll have to get it audited. But up to 3 crore, you can still go under presumptive basis. In this situation, let's take a few scenarios. First is, let's say the declared profit is again less than 8 or 6%. Cash receipts in the total receipts and cash payment in the total payments is less than 5%. In such situation, what happens is, again, 44AD is not mandatory. It is optional. It is exactly same as the earlier situation which I told, which is less than 1 crore. You can file your tax returns without getting your books of accounts audited by filling up the P&L and balance sheet, which is available in the return. Going to the next scenario, if let's assume it's again the turnover is between 1 to 3 crore, profit declared is less than 8 or 6%, but the cash receipts are cash expenses are in excess of 5%. Then again, what happens is that if at all you don't opt for 44AD, then you have to get your books of accounts audited because you have crossed the threshold of 1 crore, which is the applicability threshold for 44AB. In this situation, you can still go ahead and declare 44AD. Then, or if it is all over, you can declare that. However, in case you don't want to go under 44 AD, you want to claim that your profits are less than 8 or 6%, then you will have to maintain books of accounts and get it audited. Then let's take the scenario where 1 crore to 3 crore again, the profits are automatic, is more than naturally more than 8 or 6%. Then you can choose 44 AD, which is a natural choice that you will do because that is more beneficial and you will go ahead. So this is when the situation is the turnover is between 1 to 3 crore. Let's now take above 3 crore. That means presumptive basis is not applicable, but less than 10 crore. In this situation, what will happen is that if at all the cash receipts and cash payments are less than 5%, then again, what you can do is that you can fill up the P&L and balance sheet and then go ahead and file your returns without getting audited, because at that time, the audit threshold would have moved all the way up to 10 crores. However, if the cash receipts and cash payments are in excess of 5%, then the threshold is not 10 crore, it will be reduced back to the older threshold of 1 crore. In such situation, you have to maintain books of accounts and get it audited. And above 10 crore, of course, there is no option at all. You will have to get it audited. So this is an interplay between 44 AB and AD that I thought I'll highlight to all of you. Similarly, there is an interplay between 44 AB and ADA. This is pretty a simple thing. It's just about the 75 lakh threshold, which is there in 44 ADA. In that situation, you will have to whether get it audited or not audited is the question. I think this is pretty simple to understand, so I'll not get into too much detailing in the interest of time. Continuing some best practices that one has to adopt as an auditor. Tax audit, of course, as all of you know, can be carried out by an accountant defined under 288, which is essentially a chartered accountant in practice or a firm of chartered accountants. There is another important thing that you all should know. In case you're accepting the tax audit of a relative, there are exceptions. You can't carry out tax audit of some of the relatives. The definition is there in section 288. This definition is slightly different from the relative definition, which is there in section 56, which is talking about gift. So I would recommend that you all look at this definition under section 288 of relative before accepting the tax audit. Again, next best practice is when tax audit is being taken over from another auditor, please seek no objection certificate from the previous auditor. As a professional commitment and as a mandate by the ICAI, it is essential for us to do that. And please do not accept tax audit without seeking an NOC from the previous auditor. And in a good situation, please have a conversation with the previous auditor to identify if there are any risks of taking over that audit, whether the previous professional has been paid for the services they did and things like that. Next, you also need to ensure that SA 210 is followed, where you sign a terms of audit engagement. See, believe me, with the kind of complexity and the pinning of the blame that happens of late, professionals have to be extra cautious. So please obtain a terms of your audit engagement clearly written down. SA 210 gives you what all you can write and get it. There are good practices that are available. There are a few professionals who have already made templates of all of this and provided to other professionals to follow. Kindly make use of them. Get yourself what is the terms of your engagement, what is the fee that you want to charge, etc., and ensure that you only start an audit after that. What are we expected as tax auditors to do? One is required to express opinion as to whether the financial statements give a true and fair view of the state of affairs of the SSC in case of balance sheet and P&L account, or as the case may be, income and expenditure account. This is in a case where an SSC is not audited by any other law. In case the SSC is already audited by any other law, you can just make that audit report of the other professional who have already conducted the audit as a part of your audit report, and you are not essentially expressing an opinion on the financial statement. All that you do in that situation where it is already audited by somebody, or in the previous situation where you have to audit, is you also give your opinion whether the particulars stated in Form 3CD are true and correct. You will have to state whether the entire checklist, which consists of various clauses of in the 3CD, whether that entire thing is true and correct. So that is what you are expected to certify as an auditor. All the essays that I have enlisted here on the screen, 500 to 580, sampling, materiality, documentation, etc., needs to be followed even for tax audit engagements. In your own good interest, kindly follow all of this. That what do I mean by it? In case you're expressing an opinion on 3CD, make sure that you have your audit evidences clearly mapped out and stored as your documentation. And what are the kind of evidences to collect? When do you have to do control testing? When do you have to do substantive testing? When can you do sampling? What is a materiality that you have to fix? All of this have to be followed like in any other statutory audit that you carry out. Merely because this is a tax audit, don't ignore that. Institute guidance note clearly states that these have to be followed, and that is the only thing that will come into your rescue when you are unfortunately caught in the wrong foot. So please carry out that. So this I already told. If the books of accounts are required to be audited under any other law, you issue 3CA as the part of your audit report, and 3CD, which is statement of particulars. In the case of any others, you issue a 3CB and 3CD. 3CD is common in both the situations. Yeah, this is another interesting and an important thing. So there is a responsibility paragraph which is there in SA 700. My suggestion is whenever you are filing a 3CB or even a 3CA, there are places where you can write your comments. My sincere request to all of you, please write the responsibility paragraph very clearly, which talks about what is the responsibility of the auditee whose audit you are carrying out. That is, maintaining books of accounts are the responsibility of the SSE. And your responsibility involves carrying out audit as given under standards on auditing. So that paragraph becomes very essential. It is not academical. It is an express statement that you are making and clearly demonstrating what is your responsibility versus the responsibility of the auditee. Kindly make sure that even in the electronic filing, the option to put this out is there. Make use of it and put out that. So if you notice Form 3CD, it says you have to state whether the particulars given there are true and correct. Practically, there may be situations where 3CD is also filled up by all of you as auditors. It is not good best practice where possible, get it filled up by the auditee. You verify it, get the changes done wherever you want, and then sign off. Where it is not possible to do so, even if you help collect the particulars in 3CD, my suggestion is get a copy of 3CD signed by the SEC, keep it for your record. That may become very helpful to state that, or you are making the auditee also as a part of this entire journey of doing the audits. And it should not be felt that this is an activity that we as auditors are interested to do and only then we are doing it. In case you want to make any other observations, use the para 3 which is there, which I already told you, where you can also write the responsibility paragraph. Write down very clearly if you want to make a qualification, if you want to make a disclaimer, any limitations in your scope that came by, kindly make use of that paragraph to mention it. In fact, what we do as a practice is that we prepare the entire 3CD as a separate document. We fill up as many boxes as possible in the filing utility, online filing utility. We also state that the 3CD has to be read with, the online 3CD has to be read with the manually signed 3CD, which is also countersigned by the SSE along with the main 3CD, because there are some disclaimers we may want to write. there are some notes that we may want to highlight. Writing all that in the online utility may become difficult. Therefore, what we do is that we form out the entire 3CD separately and attach it along with the electronic 3CD. Due date, I'm sorry, the date here is incorrect. I borrowed this from a earlier slide deck that I had done. So apology for giving these dates wrongly here. The due dates are 30th September and 31st October. While the year is wrong, the dates are correct. The tax audit report is to be filed online under the CA login. You all know the process. That is, firstly, the SSE has to add you as a CA in their login. You accept it, then you upload the form, then the SSE accepts it. Only then it is considered to be complete. So in case there is no acceptance under the SSE login that happens, 3CD is and the tax audit report in general is not set to be complete. Udin, another fantastic initiative of the institute to digitally recognize the document that we sign and create a digital evidence of what we have done. UDIN can be either mentioned at the time of filing the 3CD itself or can be updated later. So make sure that you don't miss out on mentioning the UDINs after filing in case you choose to skip it at the time of filing. You also have to, as a part of this, because you're signing off the audit report stating a view on the financial statements, make sure that a signed financials is always uploaded. In case you're doing a 3CB, that means to state that you are actually getting it countersigned by the SSE, you are signing it, scan it and upload. I have seen some chartered accountants follow the method of just writing SD and uploading it. My humble request, please don't do that. Make the SSE part of the entire journey, get them to sign off, tell them the importance of what is happening. I understand practically you may have helped them a large part of the entire work itself, but making them party to it is going to safeguard you. So always get a signed financials from them. In the case where you are doing a 3CA, that is, you are signing off on the 3CD alone and then attaching the audit report under any other law. In such situations, make sure that the entire audit report and the financial statements which are signed by the other auditor is accompanied, is scanned and uploaded along with your 3CA in the online utility. Form of financial statements. In case of Companies Act, Insurance, Banking Act, etc., follow the format that is prescribed by law. In other cases, please follow the technical guide on financial statements for non-corporate entities issued by ICAI. This is a very bold and a good step that the institute has taken to sort of tell the members not to follow formats of financial statements the way one presumes to be correct. Please follow the financial statements format that is given for non-corporate entities. Year one of shift could be a little challenging. You may have been doing a horizontal form of financial statements and all of that. Here, a vertical form is suggested. Disclosures are cleanly given out. It is not too onerous, believe me. First year, there could be some difficulty in it. But after that, it will become very ordinary. I would highly recommend that you follow this. This gives you multiple advantages. The first advantage is that the financials are neatly presented. Second, all the stakeholders, the bankers who may use the financials, tax authorities who may use the financials, for them it becomes easy to read the financial statements, and any disclosures that you would want in the financials to be made, it will be clearly brought out there. So this is, like I said, consider issuing a hard copy along with the signed financial in case in each case to the SSE, so that is there on record. Now I will give you over the next maybe 20 odd minutes overview of some of the clauses of 3CD and give out some specifics about what should be done in that. This is an extract of Part A of Form 3CD, which you see on the screen right now. Clause 1, you mention the name as per the PAN. if there is a trade name, you may mention that also. In case of a branch audit, especially bank branch audit or branch audit of any other organization, which you are only the auditor of a particular branch, tax auditor of that, mention the name of that branch along with the main SSE name as well. Clause 4, mention all the indirect tax registration numbers. There could be multiple GST numbers that a particular SSE may have across various states. Take a representation from the SSE of all of them, mention all the indirect tax numbers, make an annexure if necessary to do it. The utility at least gives you where you can add rows and then keep adding the number of registration numbers. Kindly make sure that you mention all of them. Wherever old IEC numbers are there, import-export codes are there, because customs law is also an indirect tax, my suggestion is mention the IEC numbers as well. This I already told, clause 8, choose the relevant clause as per applicability based on 44AB. This is a interesting thing, clause 8A. Now, it says whether the SSE has opted for taxation under 115BA, BAA, BAB, BAC, BAD, or BAE. That is the question. You are required to answer whether the SSE has opted for taxation under any of these. Now, there are multiple difficulties. Difficulties are, one, tax audit precedes filing of return. This option can be made at the time of filing the return of income. Now, how would you know whether the SSE has opted for one of these new regimes of taxation? It could be in the case of individual, manufacturing companies, cooperative societies, manufacturing cooperative societies, etc. How would you do that? Guidance note of the institute gives out what are the methods in which it can be done. One, they say that check the previous year choice. If a choice has been made in the previous year, check that choice and try and report it based on that. If there is a form 10IB, 10IC, etc., which is already filed, that is a clear indication that the SSE is going in for a particular new regime of taxation. Therefore, you can go basis that. Obtain representation that, let's say they have not chosen anything in the past year. They are still contemplating what to do. This year, no form indicating that has been filed. So in such situation, obtain a representation and mention this under this clause to state on what basis have you written it. State whether is it based on the previous year's choice and representation, or is it only based on representation, or if they have already filed a form based on which of those. Kindly mention that, it is going to be very useful. Next, I'll go to clause 11 on the books of accounts. Firstly, section 212A defines the word books of accounts. So here, if you see the question, it says whether books of accounts are prescribed under 44AA. If yes, list of the books of prescribed is what it is. So firstly, therefore, you need to know what is books of accounts. The definition under the law is books or books of accounts includes ledger, day book, cash book, account books, and other books, whether kept in written form or in electronic or in digital form, as printouts of data stored in such electronic form or in digital form in a floppy disk, tape, or any other form of electromagnetic data storage device is what it says. Pretty much the entire gamut of whatever records are there for the financial numbers, that entirely is covered under this definition of books of accounts. Rule 6F prescribes certain books of accounts to be maintained by certain professionals. So in such situation, that also becomes books of accounts. In case there are more than one activity, for some of them books are prescribed, for some of them books are not prescribed, you please mention them accordingly. Only for certain professionals, books of accounts are prescribed. Not for all of them, books of accounts are prescribed. Only that 6F professionals, books of accounts are prescribed. If it is that, for 11A, mention that yes, books of accounts have been prescribed and give a list. In case the answer is a no to that, say a no. You don't have to give out the list which is prescribed. In case there is more than one activity that an SSE carries out, for one activity books are prescribed and for the one books are not prescribed, then make sure you mention it accordingly. You see 11B, it says list of books of accounts maintained and the address at which books of accounts are kept. In case the SSC is maintaining books of accounts at more than one location, the auditor is required to mention the details of all such addresses, along with which are the books kept where, clearly written out. You obtain representations in such situation to make sure that what you are reporting is what has been represented by the SSC. In case they are all maintained in an electronic form, the Institute Guidance Note also indicates that auditor has to mention the IP address where the digital records are stored in case of cloud storage. In case of on-prem storage, it could be mentioned that the books of accounts are maintained in electronic format in the address of the SSC, where that address is actually there. Wherever the books are kept by way of that, it could be a server, it could be a machine, it could be a laptop or a desktop. In case it is stored in a cloud storage, the IP address of that cloud storage is also required to be mentioned. Now, if you see the bracket under 11B, it says in case books are maintained in computer system, mention generated by such computer system and where what is maintained. So therefore, you need to say what out of the total books are in digital form and what are in physical form. Make sure that that is also clearly given out. 11C talks about out of the books of accounts that are either prescribed and maintained or not prescribed but maintained, what are all those which you have examined? In case there was any limitation in scope while examining that you were not made available something, stock records not available, fixed asset registers not available, etc., make sure that you clearly bring that out here. Moving on, if you see clause 12 of 3CD, it says whether profit or loss includes any profits and gains accessible on presumptive basis. If yes, indicate the amount and relevant sections. What it essentially means is that in the books of accounts that you are auditing, there are presumptive natures of income, and SSC is choosing to go under that presumptive nature of income. In such situation, indicate what it is. So there are possibly three scenarios. There are, let's say, more than one business, and one of them is being reported under presumptive basis. Let's take this as a scenario. That is an SSC. Let's take an individual. There are two businesses. For one of them, he is going under presumptive taxation. For one of them, he is going under the normal method and is not opting for presumptive. In that, there are possible three scenarios. If, let's say, there is more than one business, but combined books are maintained, basis of apportionment of the expenses is a challenge. That needs to be reported by the auditor very clearly to state that books are combined. A certain methodology of segregating the expenses have been followed by the SSC. These are the methods in which he has done it. Has to be very clearly written down. In case you're not satisfied with the method in which the expenses have been segregated, that also needs to be mentioned. This is first scenario. Second scenario, for both the business, separate books of accounts are maintained. It's very clear. Reporting is a hassle-free reporting. You can go ahead and do it at ease. Let's take a third scenario where books of accounts for the main business is maintained. Presumptive business, no books are maintained. In such situation, you will have to clearly state that in the absence of books, you have an inability to report on the presumptive business. That has to be clearly brought out in your reporting. So what also happens is that if you see 44 ADA, I think this has been inserted now recently. So this you can make out, you can use a generic clause and also talk about this. Now, going to clause 13. This talks about methods of accounting and ICDS reporting. So what are the different questions that are there here? First question that is asked is, what is the method of accounting employed in the previous year? What are the methods that are allowable? First method that is allowed is cash method or an accrual method of accounting. Hybrid method of accounting or system of accounting is not allowed. However, for different businesses, an assessee can opt cash or accrual, and that can be consistently followed. Of course, this option is not available for companies and LLPs. They have to go by accrual method of accounting only. Next question is whether there has been any change in the method of accounting employed vis-a-vis the method employed in the immediate previous year. So make sure that that is also reported. Next comes about ICDS. It has been made mandatory from 1/4/2015. And as you all may be aware, ICDS is not for maintenance of books of accounts, but for computing the income. In case there is a change in accounting policy, that does not change in method of accounting, this is a very important thing. Let's assume somebody has been following SLM basis of depreciation, switched over to let's say WDV method. That is not a change in method of accounting. Here the method of accounting is only cash and accrual to cash or cash to accrual. In case of change in accounting policy, there is no affirmative answer that you have to give to clause 13b, which talks about has there been any change. If you go further, when it talks about 13d and 13e, where you have to report whether ICDS has been followed and or not followed, what is the impact of ICDS? So for this, in case there is any adjustment to be made because of ICDS, obtain a draft computation from the assessee or prepare a draft computation, give the impact of ICDS. Based on that, you'll have to do the reporting. Obtain a standard format of disclosure. There are disclosures in various ICDS. There are certain standard disclosures. Prepare a standard format of all of them. A lot of people again have made this, and this is available in the public domain. You can adopt one of the best formats that is there to make sure that your disclosures are clearly brought out, because that is one of the requirements under clause 13, subclause F. Clause 14 talks about method of valuing of closing stock. Here, clearly mention the method of valuing the closing stock. My suggestion is wherever you're doing let's say the financial statements of a non-corporate assessee, ensure that accounting policy is very clearly written down. This is another advantage of following the technical guide of the Institute on non-corporate financial statements, where they recommend that accounting policy has to be clearly brought out. There, if you have already made the method of valuing closing stock already detailed out, you could just refer to that and say that it is already mentioned in such notes. You should also make sure that it's not enough to state what is the method of valuation. You should also state what is the method to calculate cost. It is not enough to say FIFO, LIFO or average cost. You should also say how cost is computed in various scenarios. That should also be available in the accounting policy. Next is a very interesting thing. 14b talks about in case of deviation from method of valuation prescribed under 145A and effect thereof on P&L, please furnish, and a certain format has been given. If you read carefully 145A says that you will always have to add the indirect taxes also to the value of stock. Now, based on exclusive method of accounting, you may have parked your output GST and input GST as a current asset and current liability and current asset respectively, or might be parking a net off of the two as a current asset or current liability, as the case may be. But for the purpose of valuing closing stock under 145A, it says that you should always add it to the value of the stock. However, such leeway is not available in Accounting Standard 2 or Ind AS 2. Therefore, there will always be an adjustment in 145A, but also please understand that will not either increase or decrease your profit. It is a two-side effect. If you add it to the value of the stock, that means you have already added to the value of the purchases also, or the cost of goods sold also. If you don't add it to the COGS, you don't add it to the closing stock. So my recommendation is, in every single case where there are indirect taxes, give out this disclosure in table 14B, clearly stating that if you add the indirect taxes to the value of the inventory, you'll also have to add it on the debit side of the P&L account, which will offset the P&L, and therefore that will not have any impact on the profit. Make sure that you give that out. Yeah, this is the format in which the 3CD requires you to give. Essentially, increase in profit, decrease in profit will both be same, and net effect will be 0. Moving to clause 16. Talks about amount not credited to P&L account. And it lists out what are all the amounts not credited to P&L account which you will have to give out. There are a few peculiar instances in this. Before going into that, one other thing is clause 15, conversion of capital asset into stock in trade. There is a clause you'll have to give out the description of the capital asset, date of acquisition, cost of acquisition, and the amount at which the asset is converted into stock in trade. Please note that if, as you all may be aware, that whenever a capital asset is converted into stock in trade, the year of taxation is when the stock is ultimately sold. But the disclosure in clause 15 has to be given out in the year in which the conversion happens, not in the year in which it is taxable. So that is one important thing for you all to note in case where you have a situation of conversion of capital asset into stock in trade. Now, going back to clause 16, amounts not credited to P&L account. There could be scenarios where the incomes are not routed through the P&L account at all. Let's say there is a there is a sale of fixed asset. You would not route that into P&L account. Let's say there is a sale of an immovable property in the case of a individual, and that individual maintains only combined books of accounts for his business assets and personal assets. In such situation, that entire income might have not been routed through P&L. Then what may happen is that if you see any other item of income, 16D, the question is, do you report it there? I'll raise a few other points in this and probably try and answer all of them. Like I said, clause D is residuary. There could be an investment income in the form of dividends, in the form of interest on loans that he has let out, interest on deposits that he is earning, which are not a part of his business activity, and therefore he might not have routed it through the P&L account. In those circumstances, do you report it here under 16D? One problem that some of you who might have done this reporting is facing is CPC, while processing the return, if at all you have mentioned anything here, is adding it to the income which is declared and processing the ITR and generating a demand in the 143(1) intimation. Now, we are asked to state here whether amounts not credited to P&L account, and we are asked to give a very simple disclosure. Are we expected to tell that this is not being offered to tax? Now, I don't even have a visibility of that scenario because the returns are filed subsequently. Now, how on the earth am I allowed to know that? I may not know it at all, but I still have to disclose. If it's a single financial statement that I'm auditing, and then there are other incomes in the nature of, let's say, even capital receipts, which are not at all taxable, or any other items of income, that is becoming a little difficult reporting. So one has to be very careful about it. You'll have to choose between not reporting because the irrational processing that is happening, or reporting and facing the consequences and trying to fight that out. If some of you have found a way out, I'll be happy to learn. Now, next, talking about clause 18, which talks about depreciation. Other things are all standard. One thing I thought is important to know. Here the question says particulars of depreciation allowable as per Income Tax Act. So you are required to determine the allowability and report. Section 43, which talks about actual cost definition, says that if the payment is made in cash in excess of 10,000, depreciation is not allowable on that. Therefore, you will have to determine that while reporting under clause 18. I'm choosing the important clauses alone and talking about it. Clause 20B, amount inadmissible under 3615A. Huge controversy that was there over the years, whether employee contribution can be remitted before the due date allowable under section 43B and therefore allowable or not, was a controversy. Multiple judgments. Finally, Supreme Court in Checkmate Services came out and said that the due date that is to be looked at under 3615A is the due date under the respective law. Thereafter, an amendment was also made in 3615A, which now clarifies the position. There are a few judgments which also talks about whether this amendment is applicable prospectively or retrospectively. This is one judgment of the Bangalore Tribunal that I have highlighted here, which says it is prospective. For the current assessment year under audit, it's an academical question. I don't even think there is a question or a gray area that is open as of now. It is, if the due date has to be due date under the respective law. 21A talks about various items of expenditure in the nature of capital expense, personal expense, etc. that you'll have to do. A few confusions that may come is what is prohibited under law, expenses prohibited under law, and whether an amount in penalty or not, or is it compensatory in nature, needs to be clearly thought through. If it is compensatory for a delay or a default, that I don't think so is a penalty which calls for a reporting under this clause and therefore disallowance also under section 37. That has to be looked at. One new addition that got done into this clause is also because of an addition or an amendment in section 37, which says expenditure incurred to compound an offense under any law for the time being in force in India or outside India. If there is a penalty paid out outside India, that also may come here. It's not just penalty, it says that incurred to compound an offense under any law. So there have been debates whether there is an employee settlement that is arrived at out of court settlement. Should it be disallowed, not disallowed, etc. The law, and this is a very large law. Today, my subject is not to talk about that. So one needs to be very careful while making this reporting. 21C talks about amounts inadmissible under section 40B, BA. This is in the case of interest remunerations allowable in or not allowable in the case of partnership firms. Clearly give out the computation of how this is done so that it becomes easy for one to understand. One other important thing is this old circular. The remuneration is allowable only when the deed either specifies the amount of remuneration payable to each individual working partner or lays down the manner of quantifying such remuneration. A very generic clause does not enable allowability of remuneration. So the partnership deeds have to be looked into that extent. I'm pretty sure this is a very old law, so mostly people would have figured it out. The filing utility gives the format in which the reporting is to be done. Which it gives the computational mechanism, what is the book profit and how much is allowable and all of that. Make sure that the reporting is done accordingly. 21D, disallowance or deemed income in the case of payment in modes other than banking modes. Please make sure that Rule 6DD exceptions are kept in view. Couple of important things sometimes the SSCs argue, so I thought I'll bring this out. Payment for agricultural producer by a trader to cultivator or grower is covered in Rule 6DD. But payment to a trader from another trader or a business is not covered. Let's say a restaurant can't go and say, I paid cash to the vegetable vendor and it should be allowed. That is not there. There is no exception to that. This is very clearly brought out in a CBDT press release also. So that needs focused reporting. Then 21E is about disallowance under section 40A7, which is towards gratuity superannuation fund. Couple of interesting and important things for you all to know. One is that, if there is a payment to a recognized gratuity fund, and only provisions are made. that needs to be reported here. If payment is done, it need not be reported. In case of an unfunded gratuity, that also needs to be reported here. 43B talks about a funded gratuity where you have obtained a group gratuity or something like that. 43B covers it. The unfunded or contribution to recognized gratuity or superannuation fund are covered in 40A7. That's a little overlapping there. One needs to be careful. I've gone to clause 23. I'll talk about 22 in my coming slide. Clause 23 talks about 40A2B, which is payment to specified persons, related party to be loosely calling it. So in this situation, if there is a reporting that needs to be done, you only have to do a reporting. No need to ascertain the disallowance. So there is no disallowance that you have to ascertain. It is just about reporting for making the payments to specified persons. Now, clause 22 spoke about amount of interest inadmissible under section 23 of Micro, Small and Medium Enterprise Development Act. This is what used to be there. But now one more thing has gotten added, or any other amount not allowable under clause H of section 43B of Income Tax Act, which is what is covered over here. 43BH is the new clause. So firstly, how would you determine the status of micro, small and medium enterprise? Multiple methods. One, ask the assessee to formulate a mechanism of seeking a MSME declaration from all its suppliers or vendors on an annual basis. Do a test check of all of that and determine whether the reporting and the data have been kept correctly. 43BH compounds the entire requirement because it's a new clause that got added. It says, in case there is a payment to micro or small enterprise, there is no medium enterprise here. One needs to be very careful. Beyond time limit as per section 15 of the MSMED Act will be allowed only on actual payment basis. It's not on provisioning. This is what the law says. Therefore, the method of determining micro, small and medium entity and the mechanism that has to be put in place by the SSE becomes that much more important. In case they have not done that, there is no information available, you have no choice other than to disclaim saying that you are not given sufficient information about it. Because there is only so much as an auditor that you can do. You can advise the client to have a mechanism of doing it. So this is 43BH, which says proviso permitting the due date up to the tax audit due date is not applicable for 43BH. This I already told. Micro and small entities are covered, medium entities not covered. Time limit for payment, as agreed between the parties, subject to a maximum of 45 days. So you can agree anything up to 45 days if you are making a payment to micro or a small entity. If it is beyond that, the time is maximum of 45 days. You will have to make a payment within that. If no agreement is there, the time limit is limited to 15 days from the date of delivery of goods or rendering service. This is coming from section 15 of the MSMED Act. Entity categorization. This I think by now most of you would already know. Micro is less than 5 crore turnover plus investment of up to 1 crore and so on and so forth. How to determine the turnover? It is based on the GST or the income tax data that is available. Basis that it has to be done. It excludes the export of goods or service. Turnover of GSTIN with the same PAN to be clubbed. If there are multiple GSTINs under same PAN, all of them have to be clubbed for determining the turnover threshold. This is a little bit of a relief. Some of them have confusions about it, so I thought I will clarify this. In case the MSME registered entity is a trader entity, is not a manufacturer or a service providing entity, this entire thing doesn't apply because traders can get themselves registered for various other purposes of benefits under MSME Act, like priority sector lending by bank, some MSME scheme-based loans that the government through its finance corporations are extending and things like that. But for the purpose of determining the entity covered in this reporting, Traders need not be covered. It is just manufacturing and service entities. So like this, I already mentioned, seek confirmation from suppliers every year and auditor to verify that. You could do a test check as well based on how robust the process is there. Payment terms, if there is no written agreement, invoice is one basis, people would have written net 20 days after the goods are delivered and things like that. That will become the payment terms basis which you can do reporting under 43BH. In case where the payments are not done within that, that amount gets disallowed under 43BH. And if it is paid as far as this law is concerned, is allowed only on payment basis. So if it goes into a subsequent assessment year where the payment has been made, the allowability will be in a subsequent assessment year. The reporting under clause 22 here is only to the extent of what is to be disallowed. So you don't have to give out a detailed method how you arrived at it. You only have to give out what is to be disallowed. I have a few more slides. Do I still have the time for another 5-7 minutes, or how is it? So I will continue, assuming that I have a few more minutes left for me to cover what I have. Clause 26 talks about 43B reporting. The important thing is in this clause DA and H are not here. H is not here predominantly because the reporting is already there elsewhere. Clause DA, 43B, clause DA, which talks about some payable as a interest on loan or borrowing from NBFC is not covered in this clause. So it looks like a inadvertent error. They may bring it in once they realize, is what I feel. Now, clause 27A talks about SENVAT reporting. Now, as you all know, there is only a little bit of SENVAT which is left. There is no SENVAT left after the GST has come. Whether GST has to be reported here, the Institute's guidance note on 44AB says that it need not be reported. It is only SENVAT which is required to be reported over here. Clause 27B talks about prior period expenses. One has to be careful in determining what is a prior period expenses. If an expense of a past period got crystallized during the current year, that doesn't make it a prior period expenditure. You will have to apply the test of accounting standards, 5 in particular, to determine whether something is a prior period item. If it is so, then those have to be bought out here. Then clause 29A, any sum of money received as an advance or otherwise in the course of negotiation for transfer of a capital asset, such sum is forfeited and negotiations do not result into transfer of capital asset. Now, this is a situation where there is a negotiation for a sale of a capital asset that is happening. An advance has been received. It doesn't go further. Or advance is forfeited by the receiver of advance. It is treated as an income under section 56(2)(9). What is to be reported here is the nature of income and amount thereof. In case you have a balance sheet in which such a item has come, then you will have to report it. In case, let's say there is a balance sheet of the business of an SSE, but SSE has done such a transaction outside of that balance sheet. There is a separate personal balance sheet that he is maintaining these transactions over there. There is no obligation as an auditor for you to report. However, if it is within your balance sheet, you will have to report that. 29A subclause B talks about 56(2)(10). So these are pretty simple. 269 SS, ST and T. There's an elaborate reporting on acceptance of loans, advances, or other specified sum in excess of the limits prescribed. For 269 SS and T, limit is 20,000. For 269 T, the limit is 2 lakh rupee in case of a single transaction from a single person. That reporting, the detailing is given out. In case of a property transaction, there could be a slight overlap between 269 SS and 269 ST in terms of reporting. Not a major thing. You can determine what is the more relevant out of the two clauses and report there. Make sure that the reporting is clear. On this, there is a format that is given out which asks to give name, address, PAN, or Aadhaar number of the lender or depositor, and so on and so forth. Make sure that those are reported. There could be a loan or an advance which is squared off by way of a book entry. Now, the question is 269 SS and T is very clear. It says that any other mode other than the prescribed modes you have to report. Book entry also needs reporting. If, let's say, there is a debit and a credit in a party, you set it off, and that credit was a loan that you had received, and that set off is being done. In such situation, also reporting is to be done. This is also specified in the guidance note of the institute. Then brought forward loss reporting, clause 32. You can collect this data from the ITR that is filed by the SSC, and based on 143(1) intimations that are available, make sure that in case there is a demand which is resulted or a loss that is squared off by way of an addition, etc., you report accordingly, and make sure that if there is an appeal, rectification, revision petitions, anything filed, clearly mention that laws have been exhausted because of an addition. However, an appeal against this is pending before so and so forum. Make sure that this reporting is done clearly. Depreciation loss, of course, is not impacted by change in shareholding, because the next clause, subclause 32B, talks about change in shareholding and impact of that in a company as given in section 79. Depreciation loss is not impacted, so that reporting need not happen. Then clause 33 talks about whether an SSC is claiming any exemptions under chapter 6A, section 10 deductions, or section 10AA. In those situations, it has to be done. Again, here, it is with reference to the items appearing in the books that he is auditing. Let's say there may be some chapter 6A deductions which are outside of the books. You are just auditing the books of a, let's say, an individual SSC whose business books are being audited. These things don't matter in the case of a corporate SSC, because that is very clear. So everything is in one single books. If there is a section 10A benefit, 10AA, 80JJAA, all of that is very clearly available in the same books. But in case of an individual SSC, if there are business books separately maintained and deductions are available in a separate record that he has kept, you don't have to report that under this clause. Clause 34, whether SSC is required to deduct or collect taxes as per provisions of chapter 17B or 17BB, give out the disclosure. It is not restricted to P&L items only. While you are reporting under section 40A and 40A 1A, which talks about payment to non-resident and payment to resident, there it is about disallowing of expenditure on which TDS has not been deducted. Therefore, there it may be restricted to the P&L items only. But in this clause 34, the reporting is not restricted to P&L items. If there is a capital asset which is purchased on which TDS had to be done, those also need to be reported over here. The format is clearly given out, and the reporting has to be done based on that. In order to do that, you may collect evidences in the form of ETDS returns that are filed. Get a reconciliation, if possible, from the SSC between the books and the ETDS returns. If it is not possible to get that reconciliation and you are relying only based on the ETDS returns that are filed, you may suitably mention that as remarks in this reporting, because this reporting could be in a very large SSC excessively onerous with things like 194Q, 194O, 206C, 1H, etc. This could become extremely onerous. So make sure that you suitably write down how you have done the reporting over here, and did you have any limitation in reporting. Clause 35 talks about various stock reporting. The reporting in the form of for manufacturing entities, the reporting in the form of for trading entities, etc. This has to be prepared by the SSC. You will have to resort to test check. That is what is the best practice that is possible. In case the suitable and sufficient records are not maintained by the SSC, please feel free to write that it is not maintained, so that the at least the obligation is not on you, but it is on the SSC, because it is ultimately the SSC who has to give you the records of maintaining it. Further, the clause itself states that you'll have to give this for principal items of goods traded in the case of trader, and principal items of raw material, finished goods, and byproducts in the case of manufacturer. Determine what is principal or important in them. It could be based on volume, it could be based on the value, etc. Determine what is principal. Write down how you have determined what is principal items also as a note in clause 35, and you could do the reporting accordingly. Deemed dividend has to be reported in 36A. Slightly difficult in some situations to report it. There could be a difference of opinion about what is deemed dividend between you and the SEC. The impact of a judgment of various courts could also play a role in determining what is deemed dividend under 222E. If you believe something is to be reported, report it, and give your references of why you are reporting them. Now moving to clause 40, which asks you to give various ratios. Few things, these must be calculated only for those who are engaged in manufacturing or trading, because that is what is the need in clause 40. In case of services entity, you don't have to give it, and logically you can't give it also. And when they say what are the different things, you'll have to report what is the total turnover, gross profit over turnover, net profit over turnover, stock in trade over turnover, material consumed over finished goods produced. These are the things which are asked to be reported. When they say net profit, it is net profit before tax that you'll have to consider here. If let's assume you're able to give turnover, GP and NP ratios, you're not able to give, let's say, stock in trade and material consumed or finished goods produced ratios because of want of information and having not been maintained correctly, please specify that as a part of your reporting. Yeah. Clause 44, again, another onerous reporting obligation. When it got introduced, there were multiple interpretations of how this has to be done. Here, what you'll have to report? You'll have to report the breakup of total expenditure of entities registered or not registered under the GST. Essentially, it says you'll have to report total expenditures of the entity, bifurcate it between registered entities and non-registered entities, and give out this. So there are a few things that I've gathered from the guidance note and the practices that we have been following that I will give out here. You'll have to give total expenditure and not headwise or nature wise, which is one thing that you can follow if at all. Or if you want to give headwise and nature wise and that is clearly available, you can do that as well. So the choice is yours. If you are giving total expenditure wise, make sure that the workings for that is maintained. However, you have an option to give total expenditure wise also. If you have difficulty to gather the information because enough records for that is not maintained, make sure that you report that very clearly. So that is the other important thing. In case one important and a very difficult proposition in determining this could be to bifurcate purchases from composition and regular dealers. How would you do that? Do you have to do it? Do you have to just report it as registered? And how do you bifurcate them, etc. is a difficult thing. So that needs some amount of extra audit evidences that has to be gathered. And that has to naturally flow from the auditee itself. You can't gather it as an auditor carrying out the tax audit. If payment is made under reverse charge mechanism, should it be reported? Should it not be reported? Not too sure. And if at all reported, how to report? Should we report both revenue and capital expenditure, or is it only revenue? Because the word uses total expenditure of entity. So total expenditure might include capital expenditure also. So that's another thing that one needs to determine here. One of the table headings says you'll have to report what is the goods or services exempt from GST relating to. Now, what is exempt from GST? Who should determine? Ideally, it should be the seller or the supplier who's determining what is exempt. Now, if let's say somebody has not charged GST on their invoice, how do we presume? Do we presume that they are a composition dealer, or they are presuming that it's an exempt supply, or they are an unregistered dealer? One way to break the first link, registered, unregistered, is do they have a GST number or not? It is there, then they are registered. It is not there, then they are unregistered. Now, how to dig deep into whether something is exempt or not? Do we have to sit as a receiver of the goods and services that it is exempt supply or not? Is a difficulty. So suitable notes on this can be written in the reporting itself. So yeah, so these were the things that I had thought to cover. I have finished what I wanted to speak. Now, if there are any questions, that I'll be happy to take.
Thank you very much, Krishna, for taking a very insightful and power-packed session, which could not be covered in even if you read for multiple days, but you have aptly summarized this in 1.5 hour session, to cover almost the nuances. We have multiple questions. We have nearly 50 questions received from the participants. A very good participation. I will, some of them are repetitive, so I'll just take you through major questions or wherever there is repetition and skip. And if you've covered them, I'll skip that. Yes, sir. So,
Piyush,
Piyush sir has joined the session.
Thank you very much. A very good evening to all participants. Thank you very much, Krishna. In fact, I wanted to join in the opening remarks, and I've been told that you have also covered my implementation guide on 43B very well. And 50 questions itself shows the level of discussion which has happened in last 1.5 hours. I could not join it because actually we are having a council meeting today. And as you know, this year is because this would be probably the last council meeting before the elections comes up again on 6th or 7th of December. And a lot of important agendas had to be cleared, so I could not join at that particular moment of time. As it's still continuing, it will continue up to midnight, I believe, today. But I thought I'll just venture in this point. So thank you very much, Krishna. Before the question is taken, I'll just take 4 or 5 minutes. Of course, I wanted to discuss on implementation guide, but I know you have discussed. Thank you very much again, Krishna. Thank you very much, Sumana, for joining this and moderating this important session. As the members,
so
once again,
let me introduce you to the gathering once.
I think so now.
Yeah,
Sumana,
you
okay.
need no introduction. But still, I mean, as a customary part of it, I'll just introduce
Sumana,
you.
we'll just go ahead. We'll just go ahead. Don't worry. Yeah.
Okay.
So
Okay, sir.
thank you very much. Good evening once again to all the participants. A very important session which has been completed. I'm sure I've been told that more than 50 questions has been raised. More than 1,000 plus participants were there, Krishna, today, and that's the level of interest. Predominantly, even today, most of our members are involved in tax, and taxation remains 80% of the predominant practice area of our profession, and therefore it's very important. This year, Direct Tax Committee, as you all know, has come out with an implementation guide on revision in Form 3CB. For this purpose of revision in Form 3CB, a lot of questions were being raised that why we are not revising guidance note. As you all know, that guidance note was revised already last year. We had come with a revision in 2022 and then in 2023. And hereafter, because we would have revised it, but we were awaiting that there would be some changes which will happen in the budget also. So it would be premature to revise it. So we thought we'll come with an implementation guide. Now, there is a difference which is attached as far as authority of guidance note and implementation guide is concerned. Guidance note requires an exposure draft. It requires a public comments before it actually gets, and therefore it is more of mandatory in nature. whereas the implementation guide is purely recommendatory in nature. But in this case, when 43B subclause H, an important topic was coming up and a lot of responsibility was put up on the members, what we did is we also came out with an exposure draft for the implementation guide. And we got more than 100 recommendations, suggestions from the members, and those were incorporated. I know, Krishna, you have already covered without going into that. But very importantly, my request to all the members would be, you may agree with what is, or you may not agree with what the view has been given in the implementation guide. But what we have tried to do is all the members of the group were of the view that the responsibility of auditor should be defined therein. It cannot be an open-ended responsibility. For an example, wherever I go for a lecture, I've been told that whether auditor is required to go into the website and look into all the suppliers, whether they are registered as a micro or small. I think so. My implementation guide is very clear. We'll take a list and details from them and take an evidence as an audit evidence whether they are registered or not. We do not expect auditors to go on the website and do what I would say a frisking inquiry, a roving inquiry whether he is a supplier. I don't think so. That is the responsibility. And that was an idea of the group also. To ultimately, when a chartered accountant is responsible for the implementation guide, if he's not following an implementation guide, you may be put to a question by your maybe institute or any regulatory authority for the assurance function which you have provided. So my request to you is please follow. I always say that you may feel that when the Supreme Court gives a judgment, it is a right or wrong. You may feel that, but ultimately the question is, it is final. When it comes to accounts and audit, whatever publications, whatever guidance note or standards are issued by the institute, they are final. You may feel, you may have a different view. You may feel, no, I can't ignore this. Just take an example of guidance note on tax audit, which defines turnover, though there is no provision under the Income Tax Act. Case of F&O, wherein plus and minus are added, hash totals are taken technically. But that has been accepted by various high courts. So that is the level of at which our guidance note are placed. So please do look into it without going into much more. Thank you very much, Krishna. Sorry for joining late to all the members. Thank you very much once again. I may have to again go back to my counsel. Thank you. Thank you, Krisha. Sumana, please do take questions. I'm sure my members are waiting for the answers of Krishna. Thank you.
Thank you. Thank you, sir. Thank you for the addressing. Yeah. So we'll get on to the questions now.
Sure.
So the first category of questions will be whether a particular business or profession whether a particular business, nature of activity is considered as business or profession. For example, they've asked software implementation, software development, diagnostic center, builders, NPS trust. These are the nature of services. The question here is whether it is business or profession.
Okay. I think I gave you one example of the nursing home. Going by a similar example, diagnostic center, there is a judgment, says that the diagnostic center is a business. If an individual practicing radiologist is carrying out his activity, that will be a profession. Diagnostic center itself has been held to be a business. So this has to be determined in that sense that profession needs a certain skill demonstrated by a certain individual and whatever activities that he carries out. If it is organized in a manner which is at a larger scale, which is in a certain method where there are processes written down, multiple people are involved in delivering that, but it may embed the skill of a certain radiologist, skill of a certain software professional where the activity is delivered. It will still be in the nature of business. It may not be in the nature of profession.
Okay. That was very apt. And when it comes to computation of turnover, there are multiple questions. I'll take one by one. Whether interest on income tax refund, whether it should be a part of turnover.
In my view, it should not be part of the turnover. I will try and make my answers smaller so that we can take as many questions.
Sure. And whether other income should be considered for the purpose of computing turnover under clause 40?
I feel no.
Okay. The turnover, the gross receipts of a proprietorship business is 1 crore 80 lakhs. Its net profit is 8 lakh, which is 4.44% of gross receipts. In 3CB, which clause of section 44 AB audit has to be selected,
I think my
whether it is
interplay
44
answers it.
ABA or E.
Yeah, my interplay answers it. It's a pretty simple one, so I'll not want to get into that. So anyway,
Okay.
this will be circulated, the presentation, in that they can see this.
Okay, okay. And how to compute 5% of the turnover? And
this-
whether cumulative figure for payment and receipt should be considered for 5%, or 5% for payment only and 5% for receipt only
it
for
is
the purpose of
5% for
tax.
receipt and payment separately. It's not cumulative.
Correct. Okay, thank you. Next, they have many questions they've asked on the disclosure part of it, reporting part of it. Whether penalty and interest should be reported in clause 21 with respect to late filing of GST and TDS returns.
Late filing fee, which is charged by the GST, according to me, is not a penalty. It need not be reported. Interest to definitely not to be reported, because it's just for delay in payment. If there is a penalty levied under the GST law for incorrect claim of input credit, etc., that needs to be reported. Late filing fee, according to me, is not a penalty. It need not be reported. And it need not be disallowed under 37 also, is my view.
What about show cause notices? If it is received, should we mention it anywhere?
Show cause notices alone, I don't think so. There is a need to mention. There is a clause which talks about litigation, demand raised or refund issued. Please furnish the details of demand raised, refund issued during previous year. Now, according to me, demand raised is when the order is passed and it has achieved a certain level of conclusion. Only a show cause notice, I don't think so, needs a reporting over here.
Should amount received on sale of immovable property through registered deed to be reported under clause 31A?
And clause 31.
Because the definition of specified sum speaks of advance for sale also.
Yeah. So if it is a registered deed, okay, so there is a recent judgment on this, which has come out talking about whether at the time of registration, what money is received, should it be covered or not. That's a very primitive, indication to do a determination on this. This is a slightly harder question, because there it talks about advance in 269 SS, but in 269 ST it talks about a single transaction and a single day from a single person and all of that. If it gets covered under ST, you can go under that. 269 SS, the judgment says that at the time of registration, it is not applicable, but I have a different view. The intention of the law was not that. So I think it will still get reported under 269 SS. I may be subject to change based on a judgment that will come in the future.
In clause 18, whether assessee is required to add GST, ITC availed in purchase price, and then again deduct under deductions column.
Clause 18 is about depreciation. So you have
probably.
Yeah, so I think if you're following the exclusive method and a credit is available of that respective capital asset, you will not add that to the value of the asset. In case it's not a creditable GST and you're adding it to the cost of the asset, in the actual cost definition of 43 also, it tells the same. At that time, you will add it. You don't have to deduct it all over again. I don't know if that was the clause, because clause 18 is depreciation.
In clause 44, whether salary and depreciation should also be mentioned.
There are multiple views that are being taken on this. One view is to say that replicate the entire P&L account, state what is GSTable, what is not GSTable, and disclose it. This is one way of doing it, which includes even salary and depreciation, and state that on this the GST is not applicable. One more view is only take those items on which GST is actually applicable and bifurcate them into from registered entity, unregistered entity, and give all the disclosures. So these are two views on it. I don't think so salary and depreciation needs to be mentioned, because it doesn't make any sense to mention it there.
Under section 48.2, payment to relatives, do we need to mention reimbursement of expense to holding company? Does this cover disclosure of capital expense also?
40A2 B, which talks about payments to specified persons, my recommendation is to mention even reimbursement of expenses and capital expenditures as well, because there is no exclusion of that. Again, like I said, this is a mere disclosure. You're not talking about allowability, disallowability of it. It is disclosure. So please go ahead and mention that.
Okay. And whether the reporting under section 269 SS and 269 T arise when a trustee has withdrawn amount and repaid it back to the trust during the year. The transaction was more like a transaction in the current account. A very specific question.
So let's look at it this way. So in case of a trust, assuming that tax audit is applicable for the trust, you are preparing the 3CD, then this entire question arises, number one. Number two, if the trustee is withdrawing the money and giving it back, it is not even a transaction covered under 269S, because it's a situation where the SSE is borrowing money. What gets covered under 269S, not when they are lending the money. So I think to that extent, this may not be applicable.
Okay. A couple of 43B questions. How to check whether supplier is manufacturer or a trader?
Yeah, I think this is a very good question, because so you'll have to take declarations. So there is no other way. Like Piyush sir was just mentioning, the technical guide on implementation clearly carves out what is the responsibility of the auditor. You can't go ahead auditing the supplier every time, whether they are a manufacturer, they are a micro, small. So you can only rely based on declarations that are given, or the government should come out and make a method where these are easily available and the auditee can download and keep it. As long as that is not available, you should just go by declaration and test checks.
Okay. One of the questions says we are doing tax audit as the client wants without the mandatory requirement. Is this professional misconduct?
I'm not sure about professional misconduct. It may not be, but certainly it is not something that you should be doing. It may not get covered under the definition of misconduct, but I think you should certainly not be doing it. The choice of whether a tax audit has to be done by the done or not is not that of the SSE. The law mandates a tax audit in certain circumstances. So only in those circumstances, tax audit has to be done.
Okay. For 44 AD, whether gross receipts shall include GST or only the sale value?
Again, method of recording it becomes important, exclusive, inclusive. I know books of accounts may not be maintained in a presumptive basis. Therefore, you can take a call the way you deem correct. But it has to be maintained consistently. It can't be changed.
Okay. Whether dividend paid to sister concern is to be reported under related party transaction?
I think it should be.
Whether previous liabilities written back are used in computing the turnover?
Previous liabilities written back, what gets taxed under section 41 need not be reported as a part of turnover, according to me.
Okay. Where do we mention the qualifications and representations in
Two
the
ways
tax
to do
audit
it.
record?
In the filing utility, you have various clauses that you can add. You can write and specify under what are you writing this. One way to do it is that. The second way to do it is the method I was mentioning earlier. You could make a physical copy of the 3CD or a notes that you want to write and attach it along with the 3CD.
These are the questions. We've got a whopping 73 questions till now. I've tried to cover majority of these. And thank you very much, Krishna, for taking us through the in detail entire provisions of tax audit, the 3CD form, and also giving references, relevant references to the case laws wherever applicable. If participants have any further questions, they can post now. Otherwise, we will be ending the session.
What I'll also do is I'll just put out the last slide of my deck, which had a QR code to reach out to me on LinkedIn. That QR code leads to LinkedIn. If there are any further questions that I'll be happy to take.
And a lot of participants are asking for PPT. So if you can upload the PPT or, if you can circulate it in any way, it
I
will
will
be
send it to
better.
the committee, and I'm sure
Sure.
there will be a method of circulation. So this
And
QR
the recording of this webinar will be available on icaitv.com in a couple of days' time. So whoever had network issues or they missed out attending this session, they can watch it there.
Sure. So this QR code leads to my LinkedIn profile. You can send me a message over there. I'll be happy to answer any questions that that come up over there as well.
Any further questions? I'm seeing a couple of more questions. Are you okay to take it up?
Yeah, I can take them up.
Okay. What is the status if the purchase is made on 20th February, but payment is not made as on today? Will disallowance under section 43BHS applicable?
Yeah, it will be. If it is a payment to be made to micro or small entity, and because 45-day threshold is long past, it was not made before 31st March, definitely it will be disallowed under 43BH.
Okay, so the specific question on the qualification, whether it is on clause, we have to mention in clause 3 or clause 5.
I'm not sure what does if the
Qualification with respect to the tax audit,
Okay.
whatever qualification we are mentioning,
Ah,
whether it should be in clause 3 or clause 5 is the specific
yeah,
question.
okay, understood. So in
participant
clause
has.
3, if you want to qualify on the financial statements itself, if you want to write a qualification, modify your opinion, you'll have to put it under clause 3. In clause 5, if you have specific comments, disclaimers, caveats that you want to write about 3CD, you can mention it in clause 5.
Okay. One more question we've got is clause 26B states whether sales tax, custom duty, excise duty, or any other indirect tax, levy, cess, impost, etc., is passed through the profit and loss account. Do we need to mandatorily show the GST output tax on income side and the same in expense side?
No, you
That's the
don't
question.
have to mandatorily show. It only says in case it is passed through the P&L account, the disclosure is required. It is not mandating you to route it through the P&L account.
Okay. What if the assessee is following different methods of accounting for different businesses, the turnover of which is to be aggregated for tax audit applicability?
So let's assume there are 3 businesses. In one business, somebody is doing accrual. In the other 2, they are doing cash basis, and they have been consistently following it. Whatever is the turnover according to the respective basis, which is the first business accrual and the next 2 on cash, those have to be aggregated for the purpose of tax audit.
Whether 44AD is applicable to derivatives trading?
44AD for derivative trading. Okay. There is no bar in doing that. You can adopt.
Whether vertical format of balance sheet and P&L account for non-corporate is mandatory for this year.
As far as I know, it is not yet mandatory. The technical guide only talks about it being recommendatory. I may be incorrect in saying this because we have been following the vertical form for quite some time now. So I don't really know whether it is applicable, mandatory or not, but I would definitely recommend you to switch over wherever possible.
In clause 8A, selection of section 115, if we are opting for new scheme this year, that is assessment year 24-25, do we still have to say yes and select that section? Or if kept it as it is, will it be assumed to be new scheme?
I understand what is the genesis of this question. The reason is because the new scheme is a default scheme now. Probably that is why this question is coming. So right now the question in 3CD is pretty straightforward. Whether the assessee has opted is the question. So I would think an affirmative answer to say yes, would be a better option, because that give the clarity which is necessary in preceding.
If any individual opt for presumptive income in current year and next year wants to switch out from presumptive, his total business income in the next year would be 75 lakh. In that case, is he required to get the books audited through, though it is less than 1 crore?
No, not required.
On 43B, they've asked very specific questions. Can you tell us the exact procedure to decide the disallowance amount under 43B? And how do we ensure that the complete information about 43B, whatever disallowance is there, is mentioned in the tax audit report? So if you can just take over it for 5 minutes, even if it is at the cost of repetition,
Yeah,
I think it will be helpful.
I will do that. So I firstly presume that we are talking about 43BH. It's
Correct.
the micro and small
Yes.
entity. So what
Yes,
could be
yes.
a audit procedure to do this? The first procedure is to see whether the client has any method of determining their vendors in micro, small, and medium entity at all. If they have that mechanism where they have sent out letters to them asking them to declare themselves, etc., that is the first step. Let's assume somebody has not done this at all. The entire determination fails automatically. There is no other way to do it. One, probably a very long shot way to do it is somebody may have mentioned whether they are a micro, small, or medium entity in the invoice. So that could be a second method to determine whether those are micro, small, and medium entity, especially micro and small entity. Let's assume for a minute, let's take a good case scenario where they have a method of collecting the data and the data is available with the client. So then what you'll have to do is that you can do based on a test check whether the payments were made within the timeline that is allowable under the law. So if let's assume something is outstanding 45 days before 31st March, all you will have to check whether all those outstandings, does it belong to micro or small entity? And if it is paid within 31st March, then naturally allowed. If it is not paid, it is not allowed. So these are probably the 3 steps that you can follow. Step 1, determine whether somebody has a method to follow to determine or not to determine. If not to determine, there is no other way. You can do a substantive testing by checking invoices, etc. I don't recommend really to do that. If the data is there, for those SSCs, check whether the outstanding is there. If the outstanding is there and if it has crossed 45 days, then you, or whatever is the agreed timeline within the 45-day threshold, disallow them. If it is not yet crossed 45 days and payment has been subsequently made, then you can allow it in the previous year itself. So this is like a very broad method. Have a working done out for this. Whatever is the derivative from that working, you can mention it under the clause where it has to be reported, 22, if I'm not missing it.
One specific question on book entry. Can you give us the exact reference of Institute Guidance Note? Where is it mentioned on the reporting of book entry?
Yeah, I think I can do that.
Yeah, if it's possible and feasible for you.
Yeah, just
And
allow me
yeah.
a minute.
Sure. We are again getting certain questions as to where do we get the recording of this webinar. It will be uploaded at icaitv.com in a couple of days' time. You please keep watching over there. And CA Krishna will also be showing the QR code again towards the end of the session so that you can just reach out to him through LinkedIn and can take the PPT from him.
The book entry one, I may need a little time to scan through the guidance note and give it. The one who was asked if they can reach out to me on LinkedIn, I'll be happy to share the relevant clause where this has been given out.
Sure.
And the
is clause 43 applicable to a foreign reinsurer branch?
Clause 43 applicable to?
Foreign reinsurer branch.
Foreign reinsurer, I don't know this, I'm sorry. I'm not very familiar with
Okay.
this.
No issues. One specific question is LBT, PT, VAT, CST service tax registration, whether it should be shown under clause 4. If the company is in service industry, there are past cases still pending, but it is not converted into GST.
Yeah, I think you should show it. If those registration numbers are active, you should definitely show them.
Not opting for section 44 AD and profit reported below 8% with turnover under 2 crore, whether tax audit is required.
Under how much?
Turnover below 2 crore, not opting for 44 AD and profit reported is below 8%.
If the cash expenses, cash incomes also is a threshold, that becomes important. If the cash expense, cash incomes are less than 5%, then not required. If it is more than that, then audit is required. Because then the limit is no more. If it is less than that, the limit is 10 crores. If it is more than that, the limit is just 1 crore. So you will have to do it.
Whether royalty income is 44 AD or 44 ADA. This is
royalty, royalty ADA. It is not ADA. It is, see, also it's like this. Let's say I'm a chartered accountant. I earn a royalty income for a book that I write. Let's imagine. Then probably because it is a book of professional interest that I might have written, I can include it as a part of my professional receipts and categorize it as ADA. Otherwise, it will not come under 44 ADA. Now, whether it is 44 AD, is it business? I don't think so. You can categorize royalty as a business income. It is factually determinable. If there is a research entity which comes out with patents, which gives out, maybe it can be business income, or maybe it is not as well. So it is factually determinable. And as we were talking about this, I figured out that for the book entry one also, in the revised guidance note 2023, page number 199 of the guidance note, or 220 of the PDF. If you download it from the institute's website, it is page number 220 of the PDF. If you have the hard copy, it is page number 199. In that, it is available.
Once again, thank you very much, Krishna. We've almost reached a century number of questions. I hope I have covered majority of them, and thank you very much for patiently answering all the questions. We have now come to the end of the session. The QR code.
If anybody wants it, I have put the QR code as well.
Yeah, it's available. Please, you can reach out to Krishna through LinkedIn. On behalf of everyone here, I would like to express my gratitude to the speaker of today's session, CA Krishna Upadhyay, and to the Direct Access Committee of ICAI for organizing this timely webinar, especially as we approach the 45-day deadline for completing the tax audit. And the participation was very good. We almost took 96 to 97 questions. Only 3 short of 100 questions. With this, we conclude today's webinar. Once again, thank you everyone for joining the session.
Thank you very much. It was a pleasure addressing all of you, and happy Independence Day in advance to everyone.
Thank you.